Financial markets are inherently chaotic. Asset prices move in continuous, unpredictable patterns, a mathematical concept known as geometric Brownian motion. But quantitative trading algorithms cannot process raw chaos. They require strict deterministic inputs to actually execute a trade. Before the 1970s, pricing options in this stochastic environment was largely guesswork. Traders relied on intuition and fragmented mathematical models to assign value to assets whose future prices were completely uncertain. Geometric Brownian motion dictates that while we cannot predict an exact future price, the distribution of those potential prices is log normal. This specific statistical property means prices cannot drop below zero, but have unbounded upside, establishing the mathematical foundation for continuous time market models. Capturing this exact probability distribution and translating it into a computable format is the absolute prerequisite for any modern algorithmic options trading strategy. The solution to this translation problem arrived with the Black-Scholes model. It acts as a mathematical bridge, converting probabilistic market motion into a single deterministically computable European option value. The theoretical bedrock of this model is the no arbitrage principle. It asserts that in a perfectly efficient market, there is no combination of trades that can guarantee a profit with zero net investment. Any risk-free discrepancies are instantly closed by market forces. We are going to deconstruct the Black-Scholes equation and map its multidimensional risk derivatives, known as the Greeks, directly into Python architecture. This is how quantitative traders build an automated algorithmic hedge. Black-Scholes serves as the functional programmatic engine that makes delta-neutral algorithmic portfolios physically possible. This equation shows the Black-Scholes formula for a European call. It relies on 5 core inputs: the current spot price of the asset, the strike price, time to expiration, the risk-free interest rate, and volatility, denoted as sigma. To translate this math into a trading system, algorithms map these formulas to Python's scipy.stats library. The complex integral math becomes actionable, computable functions, specifically norm.cdf of D1 and norm.cdf of D2. In this logic block, D1 represents the conditional probability of the option expiring in the money. D2 represents the risk-adjusted probability that the option will actually be executed. 4 of those 5 original variables are easily scraped from live market data, but implied volatility is strictly unobservable. It represents the market's forward-looking consensus and must be reverse-engineered from current option prices. Quants use computational root finding to solve for this missing variable. By applying Brent's method through Python's scipy.optimize.brentq module, the algorithm dynamically calculates the exact implied volatility required to align the theoretical model with the observed market price. Simply calculating a baseline option price provides little value for risk management. To survive, an algorithm must understand exactly how that price will behave the moment these underlying inputs begin to change. This graph maps option price against the underlying asset price. Delta is the first partial derivative of the option price with respect to that underlying asset. It measures the precise rate of change. Programmatically, this rate of change is calculated using the probability density function, represented in Python as norm.pdf of D1. In practice, delta serves as a strict hedge ratio. If an algorithm holds an options position with a specific delta, it calculates the exact number of underlying shares it must buy or sell to neutralize its directional market risk. The system must also track vega. While not formally a Greek letter, vega is the mathematical sensitivity to implied volatility. It quantifies the portfolio's exposure to sudden shifts in market sentiment and fear. Delta and vega provide a static snapshot of risk at a single moment. Because markets operate in continuous time, an algorithm requires second-order mathematical awareness to adjust when those initial sensitivities begin moving. This brings us to gamma, which is the derivative of delta. It represents the physical curvature of the option's value curve, measuring how fast delta itself changes when the underlying price moves. A high gamma value introduces severe mechanical risk. It indicates that delta is shifting rapidly. To maintain a neutral state, the algorithm is forced to execute frequent, computationally expensive rebalancing trades. Simultaneously, the algorithm contends with theta. This is the mathematical rate of time decay. As the time variable approaches zero, theta silently and exponentially erodes the option's premium. Black-Scholes calculates theta as an annual metric. To make this actionable for daily trading and strategies like theta harvesting, Python logic strictly divides the output by 365 to measure daily decay. A gamma-optimized algorithm operates in a constant state of tension. It weighs the protection against sudden price swings against the daily financial bleed caused by theta. The baseline Black-Scholes model relies on the assumptions of constant volatility and continuous prices. Real-world markets violate these constraints constantly through volatility clustering and sudden jump diffusion events. This chart displays an implied volatility surface. It reveals the volatility smile and skew, proving empirically that the market assigns different volatilities to different strike prices and expirations, directly contradicting the model's flat volatility assumption. To correct these flaws, algorithms deploy higher-order Greeks. Vanna measures delta sensitivity to volatility, Volga measures Vega sensitivity to volatility, and Charm tracks delta sensitivity to time. Feeding this complex math requires a robust data pipeline. The architecture utilizes requests to ingest live APIs, pandas to scrub outliers and normalize inputs, and stats models to decompose time series trends. Abstract stochastic math only survives contact with the real market when it is fed through a rigorously sanitized Python data pipeline, allowing the system to continuously calculate these higher-order adjustments. Algorithmic portfolios operate as automated feedback loops, recalculating derivatives in real time. When gamma exceeds risk thresholds, the script instantly triggers a hedging execution block. This requires composite Greek hedging. The system cannot look at metrics in isolation. It must simultaneously balance the hedges for delta, gamma, and vega across the entire portfolio. Because adjusting one parameter, like delta, mathematically alters the others, the system relies on recursive Python loops to relentlessly pursue and maintain true equilibrium. A delta-neutral, gamma-optimized portfolio is the physical manifestation of continuous, automated mathematical computation. The chaotic stochastic randomness of the trading floor is captured, distilled, and replaced by structured, deterministic logic executing silently on a server. By supplying the vectorized speed and deep statistical libraries required to process these inputs, Python transforms abstract stochastic calculus into a resilient, fully automated trading infrastructure.